It's 2006. You wake up. The sun is gleaming off your gas-guzzling Hummer. You're a part-time dog walker, yet somehow you just closed on your third condo in Florida. No down payment, no income verification. Life is good. The American economy is on steroids. The stock market is a rocket ship that only knows how to go up. The experts on TV are saying the age of volatility is over. They say we finally cracked the code to infinite wealth. But what you don't know is that the concrete foundation beneath your feet is actually quicksand. And $11 trillion of household wealth is about to evaporate like it was never there. So, what the hell happened? How did the smartest minds in the room burn down the entire global house just to roast a hot dog? Let's rewind the tape to the wildest party in modern financial history. Imagine it's the early 2000s. After the dot-com bubble burst and the towers fell on 9/11, America needed a sedative. The Federal Reserve prescribed it by slashing interest rates to historic lows. 1%. Money became cheap. Borrowing was easier than taking candy from a baby. And when money is cheap, what do people do? They buy houses. Home prices skyrocketed. Everyone started believing in a new law of physics. Real estate never goes down. Buy today, sell tomorrow, profit a portion. Banks saw this gold mine and got creative. In the old days, to get a loan, you needed a job and savings. But now, welcome to the era of subprime. Welcome to the ninja loan. No income, no job, no assets. Are you breathing? Great. Here are the keys to your mansion. Sign here. Mortgage brokers were making money so fast they couldn't count it. But the banks didn't want to keep these risky debts, so they shipped them to Wall Street. And there, the financial wizards in $5,000 suits performed a dark magic trick. They took thousands of these garbage loans, threw them into a blender, packaged the sludge into a fancy box called a CDO, and slapped a AAA rating on it. It was like taking radioactive waste and labeling it premium Kobe beef. And the world bought it. Pension funds, European banks, local governments, everyone bought these ticking time bombs with absolute faith. The party was raging, the champagne was flowing, nobody wanted the music to stop, but gravity still exists. In 2006, interest rates began to rise. Those people with adjustable rate mortgages suddenly saw their monthly payments double, triple. They couldn't pay, they walked away. Supply flooded the market, and the impossible happened. Housing prices didn't just dip, they nosedived. The pyramid scheme began to shake. Early 2008, Bear Stearns, a titan of banking, collapsed and was sold for scraps. Wall Street trembled, but they told themselves it's contained. The government will save us. They were wrong. September 15th, 2008, the day of judgment. Lehman Brothers, a 158-year-old institution, filed for bankruptcy. No one came to the rescue. The financial world went into cardiac arrest. This wasn't just red numbers on a screen. This was primal panic. Banks stopped lending to each other. Why? Because nobody knew how much toxic waste was hidden in the other guy's vault. Trust, the only glue holding the global economy together, vanished overnight. The stock market free fell. 700 points, 800 points. The masters of the universe, who thought they were untouchable, sat in their boardrooms, pale as ghosts, watching their empires turn to dust in real time. And then, the panic hit Main Street. When Wall Street sneezed, America got pneumonia. Companies couldn't borrow money to make payroll, so they fired people. Not hundreds, hundreds of thousands, every single month. By 2009, unemployment hit 10%. But don't look at the math. Look at the people. Behind every statistic was a family packing their life into cardboard boxes. 9 million American families lost their homes. Suburbs turned into ghost towns. Grass grew waist high. Swimming pools became swamps. People were sleeping in cars in tent cities right next to half-finished luxury condos. And the bitterest pill to swallow? While you lost everything. The bank CEOs, the architects of this disaster, walked away with millions in bonuses. They called it a bailout. The government injected $700 billion of taxpayer money to save the banks because they were too big to fail. Privatize the gains, socialize the losses. Rage boiled over. Occupy Wall Street filled the parks. People realized the game was rigged. If you owe the bank $100, that's your problem. If you owe the bank $100 million, that's the bank's problem. But if you gamble away the entire economy, the taxpayers will pick up the tab. The storm eventually passed, but the landscape was changed forever. The world after 2008 wasn't innocent anymore. Trust in institutions was shattered, and from the ashes of that broken trust, something new sprouted. In October 2008, A mysterious figure named Satoshi Nakamoto published a white paper. Bitcoin was born, a digital middle finger to central banking, an attempt to create money that no government could print and no bank could freeze. The economy recovered. Skyscrapers went up again. The stock market broke new records. But the scar tissue remained. Millennials entered adulthood in a wasteland, carrying a fear of debt and a deep cynicism about the American dream. The wealth gap didn't shrink, it widened into a canyon. The rich bought the wreckage for pennies and the poor just stayed poor. Today, we look back at 2008 as a history lesson. We laugh at the naivety of the people back then. We tell ourselves there are laws now. It can't happen again. But human greed doesn't change, it just shapeshifts. Maybe today it's not housing. Maybe it's crypto scams or tech valuations or AI bubbles. The market is dancing again. The music is playing loud, and the question isn't will it crash? The question is when? And next time when the music stops, do you have a chair?